Most people know the story. Steve Jobs gets fired from his own company. He wanders into the wilderness. He returns years later as the prodigal son to save the company with vision and marketing genius. That is the fairy tale. Here is the capital logic. By 1994, Jobs was not a god. He was a financial disaster. He had burned through millions of his own cash trying to sell black cubes. He was bleeding money into a small computer graphics division he bought. The media had written him off as a one-hit wonder. So how does Steve Jobs, a man on the brink of irrelevance, bully his way back into the CEO chair of a Fortune 500 company? He didn't use a phone. He didn't use a new computer. He used a cartoon cowboy. This is the story of how he used the Pixar IPO to manufacture the leverage he needed to execute the greatest hostile takeover in corporate history. To understand the maneuver, you have to understand the desperation. When Jobs was ousted from Apple in '85, he sold all his stock except one single share. He cashed out about $100 million. That sounds like a lot, but in the world of hardware manufacturing, that's nothing. He poured that money into Next. The strategy? Build the perfect computer. But let's look at the unit economics, because this is where the visionary met the wall of reality. The Next Cube cost $6,500 in 1989 money. That's nearly $14,000 today. Jobs insisted on a magnesium case, a perfect cube shape, and a specialized optical drive that was too slow for the real world. He was optimizing for aesthetics. The market was optimizing for price. The factory was automated to build 150,000 units a year. They sold 400 a month. By 1993, Next had to shut down its factory completely. They fired 300 people. The hardware dream was dead. Next became just a software company, selling an operating system nobody used. Then there was the graphics division Jobs bought from Lucasfilm for $5 million, Pixar. He wanted to sell image computers to hospitals and architects. It failed, spectacularly. For 5 years, Jobs was personally writing checks to cover payroll, roughly $250,000 out of his own pocket. He was bleeding dry. You have to realize the context of 1994. This was the era of the Wintel monopoly. Windows and Intel had won. Microsoft was crushing everyone. Jobs looked like a relic of the '70s. He tried to offload Pixar. He pitched it to Microsoft. He pitched it to Elias. He wanted $50 million to just walk away. They all said no. Think about that. The guy who founded Apple couldn't sell a future billion-dollar studio for pennies on the dollar. He was asset-rich in theory, but liquidity poor in reality. He was trapped. But then, the pivot. Pixar stopped trying to sell hardware and started selling IP. They signed a 3-picture deal with Disney. The first film, Toy Story. Now here is the critical business mechanic. Disney owned the film. They had the distribution rights. They had the merchandising. Pixar was essentially a work-for-hire contractor. They were barely breaking even on the deal. But Jobs, ever the shark, saw the potential for an asymmetric bet. Usually, investment bankers want to see 3 years of profit before an IPO. Pixar had lost money for 5 years straight. Goldman Sachs and Morgan Stanley turned him down. They said, "You can't take a cartoon company public with no profit." Jobs found a smaller bank, Robertson Stephens, and forced the issue. His logic was simple: scarcity. There were no other pure-play animation stocks. If Toy Story worked, investors would have only one way to bet on the future of CGI: buying Pixar stock. He looked at the release date of Toy Story, November 1995, and he scheduled the IPO for 1 week later. It was a calculated risk. If the movie flopped, the IPO would be worthless. Jobs would have to sell Next for scrap and likely go bankrupt personally. But if the movie hit, Toy Story became the highest-grossing film of the year.
When Pixar rang the bell on Wall Street, the stock opened at $22 and closed at $39. Steve Jobs owned 80% of the company. Overnight, his net worth jumped to $1.1 billion. This is the turning point, not the movie itself, but what the movie represented on a balance sheet. Suddenly, Jobs wasn't the failed computer guy. He was a media mogul with $1 billion of liquid equity. More importantly, he had a win. In Silicon Valley, momentum is a currency. Money doesn't just buy things, money buys optionality. And for the first time in a decade, he held the cards. While Jobs was popping champagne, Apple was dying. It's 1996. Apple is losing money, market share, and key engineers. They have 90 days of cash left. CEO Gil Amelio is desperate. Apple's operating system, Copland, is a buggy mess. They need to buy an operating system from the outside to survive. Amelio decides to buy an OS. It comes down to a bake-off between two choices. Choice A, BOS, created by Jean-Louis Gasset, a former Apple executive. It was fast, modern, and technically superior. Choice B, Next, created by Jobs. It was solid, but it was old code. Technically, BOS should have won, but Jobs didn't pitch technology. He pitched capital logic. He told the board, BOS is just software. Next is a management team. He wasn't selling code. He was selling a replacement for the executives sitting in the room. He convinces Amelio to buy Next for $427 million. Here is the genius of the deal structure. Apple paid cash, but they also paid in stock. 1.5 million shares went to Jobs. Technically, he was just an advisor, but in reality, this was a Trojan Horse. Because he had the Pixar billions backstopping his reputation, the board listened to him. He didn't need Apple's salary. That made him dangerous. Once he was inside, Jobs didn't just take the CEO job. He engaged in a ruthless capital purge. At the time, Apple was licensing its OS to other companies, Power Computing and Motorola. These were called clones. It was bringing in revenue, but it was killing Apple's margins. The moment Jobs got power, he killed the licensing deals. Wall Street panicked. They said he was crazy to turn down free money. But Jobs understood that to restore the brand's premium value, the moat, he had to have a monopoly on the hardware. He fired the board. He fired Gil Amelio. He slashed 70% of the product line. In July 1997, Amelio was ousted. Jobs was named interim CEO. He didn't take a salary. He took stock options. He had successfully sold his failed company to the company that fired him, using the reputation he built selling cartoons. Steve Jobs didn't reconquer Apple because he was a creative genius. He reconquered it because he understood leverage. When you are fighting a war on one front and losing, sometimes you have to open a second front to gather the resources you need to win the first war. Here is the logic you can apply. Liquidity is king. Vision without capital is just a dream. Jobs used the IPO to secure his financial independence. The Trojan Horse. Don't just sell a product to a company, sell yourself into their infrastructure. The sale wasn't just for software, it was an acqui-hire of the CEO. Timing is everything. He struck when Apple was weak and he was strong. Steve Jobs was a great marketer, but never forget, he was a ruthless capitalist first. If you want to understand the real mechanics of how empires are built, hit subscribe. We don't do fairy tales here. We do logic. Welcome to Capital Logic.